So we started talking about like the direct write-off method. You know, if we're not a publicly traded company, we can use that direct write-off method for writing off bad debt. So that's when we just debit bad debt expense and then we credit, you know, their accounts receivable for the person we're like, okay, they're not going to pay. So again, it's really simple, and we would just do that anytime we identified an account as uncollectible. But we can't use the direct write-off method if we're a publicly traded corporation. So while we need to understand, you know, how to do it, we're going to use that allowance for doubtful accounts. So basically, we're going to use some method to calculate how much we're going to write off as an adjusting entry at the end of the year. And then we're still using bad debt expense. We're debiting bad debt expense, but we're crediting allowance for doubtful accounts. So again, in this case, when we use the allowance for doubtful accounts, it's an end of year adjustment. So December 31st, we estimate out of all of our accounts receivable how much we think will be uncollectible. We debit bad debt expense and credit allowance for doubtful accounts. And then as the year goes, the next year goes along, we can still write off accounts. We just write them off to the allowance for doubtful accounts. Okay, so then we debit allowance for doubtful accounts and credit their accounts receivable. So all throughout the year, if you remember, we kind of talked about that allowance for doubtful accounts. It starts with the credit balance at the end of the year. The next year, it starts with a credit balance. And as we write off accounts, we're debiting that and reducing that allowance as we go through the year. So when we get to the end of the current year, that allowance for doubtful accounts can have a debit balance or a credit balance. And that's kind of where we left off, I think, according to my notes. I'm like, I think, right? If my notes were good. So I'm going to open back up the PowerPoint first, and then we'll do more practice today as well. So we learned how to do that adjusting entry. And now what we want to get into is how do we estimate how much is uncollectible in the year, okay? So I left off at allowance methods. We talked about that. Okay. So we left off talking about how we estimate that uncollectible. So what we're trying to do is figure out how much to write off to bad debt every year. So what that is, again, is an estimation at the end of the year. So again, although it's an estimate, we try to make our best, not guess, but best guesstimate at how much we think will be uncollectible. We know it's still an estimate, right? Like economy, you know, and the customers we have, like a lot of things drive our uncollectibles. But we're going to look at the economy. We're going to look at, you know, the past experience, like what were our uncollectibles last year. If our accounts receivable sales are pretty similar to last year, our credit sales, then our uncollectible will probably be pretty close. And we're going to look at the industry, what our averages. If we're a newer company, we may not know, right? We may not have a good idea. So we could look at industry and look at their averages to kind of get those first few years percentages. And then we're going to look at the future too, as far as budgeting and planning to kind of see, you know, are we changing? Have we grown at all too? You know, we may forecast and look if our credit sales is increasing each year, our bad debt expense is probably going to increase as well. The more we sell on credit, the higher that bad debt will go. So if we think we're going to have, you know, more sales next year, we might consider that when we're setting that bad debt expense. So there's two main methods. We have what's called the percent of sales method, which is really easy. And then we have the analysis of receivables method, okay? And so we're going to look at, again, trying to figure out that adjusting entry at the end of the year. So since accounts receivables are created by credit sales, you know, our credit sales drive our accounts receivable, we can estimate our uncollectibles based on a percentage of our credit sales. So we can say 1% of our total credit sales might be uncollectible, or 5%, or whatever. Again, they're going to give you the percentages in here. We're not going to come up with those, but those are the forecasting and the estimates and all of that the industry is doing. So for example, we have Extone Company. On December 31st, before any adjustments, we have a balance on our accounts receivable of $240,000. Our allowance for doubtful accounts has a credit balance right now of $3,250. And we have total credit sales of $3 million. So pretty big amount. They're saying they're going to use the percent of sales method to try to do that adjusting entry. So
to get bad debt expense?
Yes. Yeah, exactly. Yeah, all we're doing is looking at a way to calculate what our bad debt expense will be for the period. So they tell us, they estimate that 3/4%. Don't you love it when they give us fractions? So 0.75% or 0.0075, okay, is going to be written off as bad debt. So all we have to do is take our $3 million in credit sales and multiply it by 0.75%, okay? And that tells us we're estimating our bad debt expense at $22,500, okay? So percent of sales, you truly just take your total credit sales by whatever percent they give you they think is uncollectible. It's really pretty simple, right? That one's nice and easy. And then this is your adjusting entry. December 31st, it's an adjusting entry into the period. Bad debt expense gets debited, and allowance for doubtful accounts gets credited. The $3 million times 0.75%. So we estimate $22,500 is uncollectible. So bad debt expense gets debited, allowance for doubtful accounts gets credited. Okay. When we're doing any allowance for doubtful, the allowance method, it doesn't matter which estimate we're using. Our journal entry is always a debit to bad debt expense and a credit to allowance for doubtful accounts. That structure stays the same. All we're learning now is how to calculate the amount. Okay. And this is just showing you how that's affecting the two accounts that it's affecting. So bad debt expense, this is the first time we've used it because expenses are temporary accounts. So every year we close them out, okay? So it's the only entry to bad debt expense is $22,500, which again, that's reducing our profit. You know, that's coming out of our revenues. It's an expense. The allowance for doubtful accounts, they told us we had a balance in there of $3,250. Well, it's a permanent account. So when we do that adjusting entry under percent of sales method, we now have an updated or adjusted balance. Okay. So now our allowance for doubtful accounts has $25,750 in it. So if we use percent of sales method, this is how these accounts are affected. Okay. So the better method, though, which of course is more complicated because that's how accounting always works, right? We're like, oh, this is the easy way. We don't do it that way. The better method is to do some kind of accounts receivables method. And the one we're going to look at in this class is the analysis of receivables. So accounts receivable allowance methods are more accurate because we're not looking at just our total credit sales, which are temporary, just this year's credit sales. We're looking at our total accounts receivable balance, which is a permanent account. So it's carrying over from year to year, okay? So when we look at our accounts receivable and we base it off of our accounts receivable, it's going to be more accurate because that's the money actually owed to us, okay? So in this case, we're going to do what we call analysis of receivables method. So we kind of know, right, the older than an account gets as far as past due, the more past due an account gets, the less likely we're going to collect any money, you know, in general. So, you know, once an account gets to like 150 days, the chances of us actually seeing that money go way down. It makes sense, right? If they haven't paid in like 4 or 5 months, are they really ever going to pay? Probably not. So this method is a little more accurate because we're going to figure out how likely it is to collect on the money owed to us. So we're actually going to look at what portion of that accounts receivable is current, like, you know, what's hasn't even been due yet. It's within 1 to 30 days. And then how much of that debt is like 30 to 60 days past due, and how much is 60 to 90, and, you know, 90 plus, and all of that. So we're going to look at it, we're going to analyze it, and the older the debt is, the less likely we will collect on it. So it's a little more in depth and a little more accurate. So it looks like a lot of steps. I'm not going to read through those because I'm just going to show you. Because it's a lot of steps, and we're going to do one together. So again, basically what we're going to do is we're going to age or do an aging of the receivables. So we're going to look at all the money due to us and categorize it as current, past due up to 30 days, past due up to 60 days, so on and so forth. So aging the receivables. So I'll show you this and we'll talk about the steps. So this is a nice little Excel spreadsheet that they're keeping, which makes it easy to add up. So we list all of our customers, all of our accounts receivables, and then we list their balances. So we would have all of our customers listed and all of their balances. And then we just put it into an aging schedule. So we look at, well, how old is this debt? So the second step after we list all the customers and the balances, we list out how past due it is. So Ashby and Company, we look, they owe us $1,500. The days past due falls between 31 and 60. So it's somewhere between 31 and 60 days past due. BT Bar owes us $6,100. $3,500 of that is 91 to 180 days past due. $2,600 is 181 to 365 days past due. We should stop selling to them, and we probably already did. But this tells us that too. As we do that aging, it's like, okay, wait, they're not paying their bill. You know, they're cut off. And then Brock Company, it's not even due yet. It's not past due. So their bill is current. So we would do that for every customer. That's the first 3 steps. And then step 4, we're going to add up our totals in each category. So the total accounts receivable, which they told us in the last example, the total amount due to us is $240,000. Of that, $125,000 is not even past due yet. So that's pretty good. You know, over half is still current. So there's a pretty good likelihood that we'll collect on that. Okay. And then as we go through, you know, we have $64,000 that's 1 to 30 days past due. Not a huge deal. Then thankfully our balances kind of go down, but we do have $14,000 due to us that's over a year past due. Again, the chances of collecting on that when it's over a year are very slim. So that's step 4, add up the totals in each category. Step 5, and they're going to give you these percentages. They're going to have some kind of historical data and, you know, all that industry average. They're going to come up with how much of each category is uncollectible. And if you start out on the right, we're going to assume that anything that's over a year past due is 80% uncollectible. It's pretty much a guarantee we're not going to see that. Okay, so then they just take 14,000 times 80% to get 11,200. That's some of our uncollectible accounts. And then we just do that for each category. If it's 6 months to a year past due, we consider it 50% uncollectible. So we multiply. If it's like 3 months to 6 months past due, 30%. 60 to 90, 20%. 31 to 60, 10%. 1 to 30, down to 5%. We still have a really good chance of collecting on debt that's only 1 to 30 days past due. Hopefully the check's in the mail. And then our not yet due or not past due is 2%. Okay? So we multiply all of our totals to get our total uncollectibles, and we just add them all up. So our total estimate then becomes $26,490. So again, we think total out of $240,000 owed to us, we think we are not going to collect $26,490. That's the total bad debt we think we'll have out of that accounts receivable. Okay, so that's just aging the receivable. It's not very difficult. It's just, you know, breaking it down and doing the multiplication, okay, putting it in a schedule. So again, our end goal is to come up with this uncollectible amount. That's the amount that we're going to want in our ending allowance for doubtful accounts balance. Okay. But before we move on there, we're going to do an example together and just do an aging of accounts receivable before we talk about the journal entry part. So if you haven't already, go ahead and log into Canvas and open back up that Chapter 8 practice that we were working on last Thursday. And I believe we're on the third one. Yeah. So we're on Chapter 8 practice, the third one, where we're actually doing an aging of accounts receivable to estimate our allowance for doubtful accounts balance. So, Ever Industries has a past history of uncollectible accounts as follows. So they give us their aging schedule. So if it's not yet past due, they assume it's 1% uncollectible, 1 to 33%, and so on. Okay, so we're using this percentage information. And then they've actually started the table for us. So it says estimate the allowance for doubtful accounts based on the aging of receivables provided in the chart. So we're going to find this number last. So again, all we have to do is take our not past due, because they already gave it to us, we didn't even have to type it in, times 1%. So how much do we estimate will be uncollectible out of what's not past due? Very good, $6,074. So 1% is $607,400. How about if it's 1 to 30 days past due? Very good, 6,990. So 3% of 233,000. 31 to 60.
$14,592.
Very good. 14,592. 14,592. 61 to 90. Good. 28,950. So 30% of 96,500. And then last but not least, anything over 90 days past due, they assume is 75% uncollectible, which would be 49,500. 49,500. So once I do my aging schedule, all I need to do is add all of those up, and that'll give me my total desired balance in allowance for doubtful accounts. So I add those 5 up.
106,000.
Very good. 106, 106?
Yeah.
Yeah, very good. So 106,106. Okay. So again, on your homework, they may have you actually type in, from the chart, the percentages and the amounts and everything. But all you're doing is multiplying and then adding. Any questions on that one? That's easy, right?